Hey, are you satisfied with this year's tax return? Or have you ever wondered why you get a tax refund? At the end of this video, you're going to know exactly how to generate more tax refund, so you will have more money back in your bank accounts. Hey there, this is Thomas. Better mindsets, better life. Every year in April, we're responsible for reporting our total income and pay the amount of tax due. But at the same time, it's our right to pay only the amount that's due and reduce tax legally. So in this video, I'll give you a step-by-step walkthrough on how tax filing works and where you can work on to reduce more taxes. But before we go, I want to put a disclaimer first. I'm not an accountant. This is not a video encouraging you to DIY your tax filing, and certainly not a video giving you any tax advice. This is just a video to let you understand how taxes work, so please make sure you do your own due diligence. Let's jump into it. A lot of people are looking forward to their tax return so they can spend on it. This money is not a gift from the government, it's coming from your own pocket. If you are a 9-to-5 employee, say your salary is $60,000, you should have a $5,000 per month in theory. But that's never the case. A portion of the paycheck already advanced to the CRA account, and usually the company you work at will deduct a little bit more than it should be. So by April, after you file your taxes, then the CRA will refund the money back to you. So first thing first, in order to maximize the tax refund, we have to understand how does the tax filing work. No matter if you are hiring an accountant or using an accounting software, the goal is to fill out this bad boy here, the T1 General Form. The T1 General Form is also called the Income Tax and Benefit Return. It is the document used by the Canadians to file their personal income taxes. The form is a summary of all the other forms you completed for your income taxes. It reports all your income, deductions, tax credits, and more. And then you can use it to apply for the benefits like the Canada Child Benefits, the OA Security, the GST, HST tax credit rebates, and more. Sounds very complicated, right? Let me break it down for you in a 3x3 steps. There are 3 major parts you need to complete for the tax return, and there are 3 takeaways for each major parts. The first part is your total income. You input all sources of income in here, and I simplify it into 3 different sources. The first one I call the active work income, such as the traditional employment income, self-employed, or the commission income, most of the Canadians' bread and butter. The second one is the passive income, such as the rental income, the spousal support, the interest, dividend, and capital gain on your investments. The last subcategory are the social benefits payout, such as EI, Canada Pension Plan, OA Security. I will also include the RRSP and the pension plan withdrawal in here. They all come in various forms of tax slips, and you should receive all of them by beginning of the year. The next part to increase your tax return is to find ways to reduce the total income legally. The CRA call it the net income and the taxable income, but I pretty much simplify it and call it as the income deduction, because this is where you can write off your total income. I named the first category as the plan deduction, such as RRSP or pension deduction. The amount of money you contribute to your RRSP or pension plan is in a 1-to-1 dollar ratio. So if Tom's income is $100,000, he should be paying 30% income tax. That leaves him to $70,000. If he contributes $10,000 to his RRSP plan, then his income is $90,000. We keep it at 30% tax bracket. That leaves him with $73,000, and he still have $10,000 in his RRSP. The second one is the expense deduction, such as business expense, things that you have to keep your business going. The other one will be childcare expense, spousal support if you're the one who's giving the support, moving expense if you move 40 kilometers away because of work or school. And there's one more expense in this section, not a lot of people are aware of, but you can generate more tax refund once you know about it. I'll come back to this in a bit. And the last subcategory are your investment losses. You can claim your capital loss on your investments, but any investment gain or loss inside the RRSP or tax-free saving will not trigger any tax implication. And after you finish all the reduction, then it becomes your taxable income. The last thing to fill out in the T1 General is the tax credits. Tax credits further reduce the tax amounts that you owned by a fixed amount, while the tax deduction reduces the tax amounts you owned based on your marginal tax rate. The 3 key takeaways are tax credits can be neither refundable or non-refundable. A non-refundable tax credits can reduce your tax bill but will not give anything extra when the balance reaches 0, where a refundable tax credits can reduce your tax amount to 0 and further Therefore, the CRA has to write a check back to you. For instance, if Henry owed $1,000 in taxes and he had a non-refundable tax credit of $1,500, he doesn't have to pay any tax but will not get anything extra. Versus if Henry had a refundable tax credit of $1,500 instead, not only he doesn't have any tax owing, but he will also get a $500 check from the CRA. The second takeaway is the most common examples on non-refundable tax credits are the basic personal amount, tuitions, interest that you pay on your student loans, donation, and more. There are not too many of refundable tax credits, but the most common ones is the GST, HST tax credit rebates. And the last takeaway is tax credits are more favorable to low-income earners or students. If you're in high-income tax bracket, then it makes more sense to focus on the tax deduction rather than the tax credits, as it saves more in taxes. So there, after all your income, tax deduction and tax credits are calculated, the remaining balance will be taxed accordingly to the federal and the provincial tax system. If you're a 9-to-5 employee or self-employed who prepay the taxes, after tax filing in April, the CRA realizes they overcharge you, so you can get a tax refund. Vice versa, if you did a lot of overtime or you get a very nice bonus, then by April, the CRA will come in knocking your door looking for their money. A quick recap in here. The 3x3 steps are the 3 things you need to know to file your taxes. That's the total income source, the income deduction, and the tax credits. And there are 3 key takeaways for each section. And I encourage you, after this video, download a copy of the T1 General so you can refresh your memory. I'll put the link down below in the description box. Okay, remember I said there's a column in step 2 that not a lot of people are aware of, but is effective in lowering the taxable income. It's called the line 22100, carrying charge. There are 8 things you can write off, but I just pick a few. There's the advisor fees, where you can write off your fees when you hire a financial planner to give you money advice, or certain legal fees when facing spousal or child support payments. There's the policy loan fee. If you have a permanent life insurance that has cash value, you can borrow against from it and the interest can be write off. The last one is the interest that you borrow to invest. It's that you can write off the interest if the money that you borrow produce an interest and dividends. For example, if I borrow $100,000 and invest, the interest is at 5%, I can reduce the $5,000 off from my income. This will become really effective when combining with the RRSP strategy. If you guys eager to know more, you can leave a comment and say, I want to know more. I'll put it on my top priority if I get enough comments on this. This is Thomas. Thanks so much for watching guys, and be sure to like, comment, and subscribe to the videos if you find them useful. Your support really means a lot to me. If you want to learn how money works and how you want to work with money, then I'll see you in the next video. Bye guys.